Good afternoon, everyone. We appreciate you spending some of your day with us. Right now, it's about 2 p.m. here on the East Coast. I'm Errol Barnett.
And I'm Lana Zach. We are now just moments away from the Federal Reserve's decision on interest rates following its latest meeting.
Now, the central bank is not expected to cut rates because key economic data shows inflation just persists across the country. The last rate hike, you may remember, was back in July of 2023, and rates have remained steady since.
CBS News business analyst Jill Schlesinger is here with us in Studio 57, and CBS News senior business and tech correspondent Ling is in our Los Angeles bureau. Jill, I'm going to start with you. Talk to us about why it's unlikely that the Fed will once again decide to leave
do a lot of nothing.
Yeah,
They're exchanging recipes. Don't worry about them. You know what? Inflation is not coming down to where the Fed wants it to be, or where any of us would want it to be. And we're not just talking about the overall level of prices. When we talk about inflation, remember, it's the pace of increase. And we want to see this rate come down towards 2%. And right now it's more like 3 or 3.5%, depending on the measure. So the Fed does not need to take any actions until they get more evidence that the inflation rate is coming down, and we have not gotten that yet.
And let's bring in Ling, who I learned today goes by the nickname JLK.
Totally.
I didn't know this. I want to be cool with the kids here. So JLK, what recent data should we be looking at, is the Fed looking at, that plays into today's decision?
Yeah, they're looking at all kinds of data, but the main point here is CPI, is the Consumer Price Index. That's what they're looking for. They're also looking at producer prices. They're also looking at other types of measures in terms of rent inflation. But we do know that the Federal Reserve now is going to leave interest rates unchanged. They're citing a lack of further progress on inflation, so they're going to be holding interest rates according to the press release from the Federal Reserve. They basically say that they don't see the progress on inflation moving downwards towards that 2% target, and they see risks to achieving a dual mandate, and they've got to move continually down towards that 2% target that they have cited many, many times, that Jill and I have been looking at for a long time now. But another hold to the disappointment of a lot of people who are trying to enter the housing market to get lower rates on their credit cards and to get car loans, guys.
So, Jill, what does this mean? It's as predicted. Rates hold steady, but, you know, everyone's feeling the persistent cost of higher rates this past year. So what does this mean for the near term?
So, like JLK just said, if you're borrowing money, it's a bummer. It's just a bummer. And if you're financing an outstanding credit card balance, it's really bad news. But I want to flip it. If you're not a borrower, maybe you're a saver. And in that case, it's amazing news, because you can go out and get a CD for 3 months, 6 months, 12 months, 18 months, and you can park your money in a money market account or a high-yield savings account, and you can earn 4 or 5% interest. So while this is not great news if you're a borrower, it is really good news if you're a saver. You get to keep more money and earn more interest. And I think this is actually helping a lot of people feel able to spend a little bit more. Because if you've got money that's making money, even if prices are higher, you're like, well, the money in my emergency reserve fund is making money, and it gives you a little more confidence.
Well, we certainly see that people continue to spend. That's part of the reason why the Fed made the decision that they did today. So, Ling, let's talk about what we might see later in the year, because we were expecting that possibly this May meeting would be the beginning of cuts. Now we're even hearing maybe there won't be cuts, or maybe there could be a little uptick in interest rates. What are you thinking is going to happen over the course of the rest of the year?
Economists have largely been expecting the first cut to come at the June meeting. We knew that May was highly unlikely, but now, given these inflation rates that have basically been stuck for 3 months at this elevated level, June is a huge question mark. And in June, we'll also get a forecast from the Fed in terms of what the economic outlook from their perspective is. And so that's important for consumers to look at and see what could be coming down the pike. But 3 interest rate cuts this year, basically off the table table. A lot of the market is basically saying we don't expect a June rate cut given the current situation. And looking at the press release, it's essentially holding until further notice is kind of the vibe that we're getting from the FOMC. And so looking ahead, maybe a cut in September. The issue there, as Jill and I have been talking about, is that there's a worry that the Federal Reserve is concerned that they may appear political in nature. They try to keep it separated like church and state in terms of rate cutting and the general election coming up in November. So we'll see. There's a possibility for December as well. But a lot of this is riding on what the data tells the Fed and what it tells Chair Powell. What does it indicate? And right now, it does not indicate that inflation is going down. So we've actually heard some chatter from one of the Fed governors, Bowman, saying maybe we should consider a rate hike. But that is very much the minority opinion at this point. I think from the folks I've been talking to on the Wall Street side, it seems like a very unlikely minority-held opinion at this point. But there's a question of, are these higher rates doing enough to bring down inflation?
So if a rate cut, and it seems like you're both on the same page with saying that's kind of off the table for the short term this year, you know, rates holding steady as they are is the best case scenario. What does that mean to viewers as far as the financial decisions they may be making throughout the rest of the year? JLK had mentioned that housing still remains one of the highest costs and areas of inflation. So what does this mean for how we decide to navigate our money?
You know, in the beginning of the year was interesting because we were expecting better progress on the inflation rate.
Right.
And as a result, we saw mortgage rates starting to drop down a little bit below 7%. And that was kind of like, oh, yeah, like it's moving in the right direction. Now with this resumption of the fear that all of a sudden the Fed's not going to cut rates, what do we have? We have mortgage rates creeping higher. So I think there's, again, a double-edged sword. I always think about in the economy, there's often winners and losers. And the winners are all those people who bought their homes and locked in those rates. And those folks are so psyched. You know, 60% of the people who actually have outstanding mortgages, those mortgages are below 4%. So that's actually a problem if you're thinking about the housing market, because why would I list my house if I have a 3% or a 2.25% mortgage?
Right.
So I think there's a real problem for the new people entering the market. It becomes more and more difficult. I think a lot of people are forced to use different kinds of mortgage products, the kinds where they would have to refinance, but it's not the worst thing in the world. Just like take a deep breath for 1 second. I know that we're talking about the rest of the year, but we have come from these horribly high inflation rates. We're down at this 3-something level, and we are going to get back to a more normal pace of inflation. It just may not happen as quickly as we'd like. So again, if the real reason that rates are high is because inflation remains higher than we want, then we want rates to stay high. We do want that inflation rate to come down. And if you're making financial decisions, you're not making a 6-month decision anyway. You're hopefully making a 6-year, a 16-year, or a 36-year decision.
Yeah, but we do know that Americans are carrying more credit card debt. And Joe Ling, with the April jobs report coming out on Friday, what are you expecting to see about where the labor market stands? Because obviously the hot labor market has helped to fuel all of the consumer purchasing that's continued this inflation to be unabated despite some of the Fed's actions.
Well, first of all, amen to everything Jill just said, as she's completely on the mark, as usual, and just has it all covered. And I just want to say that in terms of the jobs report, we expect a strong jobs report. Depends on who you ask in terms of like what the numbers are actually going to be. Unemployment is expected to stay relatively stable. And so the discussion here is, if the jobs market remains as healthy and robust as it is, what does that tell the Federal Reserve in terms of their decision making? And if it continues apace, we're also going to be looking at what the revisions are, if there's any changes to the prior month and the month before, looking at back earlier in this year. But that jobs data is critical to the decision that the Fed will make, but nothing is as important as the rate of inflation. And in terms of the housing market, I think what's also so frustrating for people is, in addition to what Jill said, with mortgage rates creeping up higher, it's hard to get in too, because supply remains so tight as a result, and prices just continue to go up. It's the affordability. It's like a double whammy, guys.
Right. All right. Joe Ling, Jill, thank you both.
Yes, thanks, guys.